When we talk about the artificial intelligence revolution, our minds almost instantly jump to the flashy, headline-grabbing tech giants, right? We picture these sleek silicon chips, the massive software ecosystems, and just these sprawling server farms from Microsoft, Amazon, and Google. But behind all of that digital magic, there is a very physical reality. AI requires a gargantuan, honestly almost unfathomable amount of electricity just to function. And that brings us to the hidden engine quietly making this entire AI boom possible. Welcome to today's Explainer, where we're going to look past the software and actually uncover the massive, totally unexpected player that's quietly powering the future.
Okay, let's dive into this. If I asked you to guess which company is the real picks and shovels winner of this AI gold rush, you'd probably guess, I don't know, a semiconductor manufacturer or maybe some massive data storage firm. But the truth is actually far more grounded in traditional industrial mechanics. See, the servers crunching these complex AI algorithms generate intense heat. They demand constant, uninterrupted, massively dense electrical currents just to avoid catastrophic failures. So who exactly provides that highly specialized infrastructure?
Well, the answer is a company sitting on a staggering market capitalization of 156.90 billion US dollars. Yeah, billion with a B. And here's the twist. This is not some flashy Silicon Valley startup born in a garage 5 years ago. No, this is a legacy industrial company operating out of Beechwood, Ohio, and they are quietly cornering the market on the critical infrastructure that is literally keeping the internet running. That company is Eaton Corporation, traded on the New York Stock Exchange under the ticker ETN. Eaton has totally emerged as the absolute linchpin of modern AI data centers. With over 85,000 employees globally, they are basically the ones hyperscalers call up when they realize they need entirely new power grids just to turn their AI supercomputers on. So here's our roadmap for today's explainer. First, powering the AI boom. Then, a century of transformation. Third, the infrastructure monopoly. Fourth, financial health and strategy. And finally, calculating the risks. Let's start with part one, powering the AI boom. AI models are notoriously power hungry. Traditional data centers simply aren't built to handle the intense electrical load of modern processors. They just aren't. And that is exactly where Eaton steps in with what they call intelligent power management. In practice, this means they manufacture and provide the highly engineered electrical components that stop servers from, well, frying. We're talking about massive uninterrupted power supplies, heavy-duty switchgear to safely distribute insanely high voltages, and even entirely self-contained microgrid solutions. When hyperscalers think Microsoft, Amazon, Google, when they build their next-generation facilities, they literally rely on Eaton's hardware to solve these unprecedented power density challenges. Okay, let's move to part two and see how this builds. A century of transformation. What makes Eaton so fascinating isn't just what they're doing today, it's where they came from. Get this, they were actually founded way back in 1911 as a traditional automotive parts manufacturer. For decades, the name was just synonymous with trucks and heavy machinery. But fast forward to fiscal year 2025, and they achieved a record-breaking $27.4 billion in consolidated revenue, heavily driven by digitalization and electrification. And the pivot doesn't stop there. By Q1 2026, they finalized an $11 billion strategic acquisition of Boyd Thermal, which basically internalizes crucial data center cooling capabilities. And looking ahead to Q1 2027, they plan to completely spin off their legacy mobility segment. So they are literally shedding their past to embrace the future. Which brings us to part three, the infrastructure monopoly. Now, what's really interesting about this slide is how it breaks down their near monopoly dominance across their operational pillars. So while they still have really successful aerospace and mobility segments, supplying precision systems for aviation and powertrains for vehicles, the electrical segment, both in the Americas and globally, is the absolute core growth engine. This right here is where the AI boom is actively showing up on their balance sheet. And the data backs this up dramatically. The unprecedented power density required for AI led to an astonishing 42% organic surge in their 12-month rolling orders by the first quarter of 2026. I mean, this is direct evidence of hyperscalers essentially panic buying power infrastructure to ensure their AI rollouts aren't delayed by a simple lack of electricity. On top of that, Eaton is also a principal beneficiary of the U.S. Infrastructure Investment and Jobs Act, meaning they're securing massive government contracts for grid modernization on top of all that private tech money. Let's look at part four, financial health and strategy. Looking at the quantitative proof from their first quarter 2026 earnings report, their revenue hit a historic peak of $7.45 billion. That's up almost 17% year over year. Their total assets also ballooned by over 40% to hit $55 billion, which really reflects their aggressive acquisitions and expansion. However, you'll also notice a dip in net income, down to $866 million, and a contraction in their net profit margin. Now, as we'll see in a second, this is a direct reflection of the massive capital required to scale up their operations and integrate those new mega acquisitions just to meet all this future demand. And this brilliantly illustrates exactly why they're spending so heavily to scale up. Take a look at this massive 44% year-over-year jump in their Electrical Americas backlog between Q1 2025 and Q1 2026. A backlog like this essentially represents guaranteed future revenue. The customers have already placed the orders. They need this stuff yesterday. Eaton just needs to build the factories fast enough to actually produce the equipment. So, to capitalize on all this guaranteed demand, management has initiated this really bold, dual-pronged strategic shift to turn Eaton into a pure-play, high-margin industrial technology firm. Step one was finalizing that $11 billion integration of Boyd Thermal, which allows Eaton to offer full-service data center cooling right alongside their power systems. It's a true one-stop shop. Step two is an agreement to combine their slower-growth mobility business with Dana Incorporated in a $5.1 billion deal. This effectively spins off their legacy automotive roots completely by Q1 2027. Finally, Part 5, Calculating the Risks. Of course, no corporate transformation comes without its headwinds. So the crucial point is how you weigh the overall investment thesis. On one side, you have the AI monopoly thesis. Eaton enjoys operating margins approaching 25% and generated a massive $3.6 billion in free cash flow back in 2025. That enables really strong dividend growth and share repurchases. But on the other side, you have real market risks. That dip in net income we saw earlier highlights the potential for ongoing margin compression, simply due to the heavy costs of ramping up entirely new North American manufacturing facilities. But perhaps the most significant risk is captured perfectly in this quote from the source analysis. Eaton's premium valuation is inextricably linked to sustained AI infrastructure capex by hyperscalers. Put simply, while Eaton is a structural giant with a fortress-like balance sheet, its immediate fate is still heavily tethered to big tech spending habits. If the macroeconomic environment slows down, or say if big tech delays the monetization of their AI models, the capital expenditures flowing into Eaton could face a really sudden contraction. Eaton has masterfully positioned itself right at the center of the world's most important technological shift. They've transformed from a century-old auto parts maker into the indispensable beating heart of the AI data center. They are quite literally building the physical world that makes the digital world possible. But it does leave us with a fascinating question regarding the fragility of this entire ecosystem. If big tech ever decides to hit the brakes and pause their unprecedented AI spending, what happens to the massive billion-dollar physical grid they left behind? Thanks for joining us for this explainer. We'll see you next time.